Hi everyone, I'm Quan Ray. Welcome back to the channel. So in today's episode, we'll be talking about some news, some earnings this week, as well as some interesting ideas that I've put on my watch list. So as we all know, the markets have been up 8 weeks in a row already. So I'll be covering some interesting earnings as well as SpaceX IPO. So the first earnings that I'll be covering is Intuit. So Intuit is down around 25% over the past 5 days. It was a company that was previously loved by investors in compounding machines. And for Intuit, the company actually beat its earnings expectations. But the reason why the stock was down is because of this TurboTax segment of the business. So the management actually came out and said that TurboTax lost on price. So this was actually a signal to the markets that, maybe TurboTax is a commoditized product and that's why the stock fell by so much. And the AI is killing software narrative is still around, with the company reporting significant deceleration in terms of revenue. But I think the 20% drop was probably exaggerating the level of quality of this earnings report. The earnings wasn't actually that bad. They raised guidance for end of this year as well. They beat earnings expectations. So I think there's a few pointers to learn from this Intuit sell-off. Number one is that valuation matters. So Intuit was previously trading at, I believe, 60 times earnings, 70 times earnings at one point as well. It is currently trading at 18 times. And second of all is to be careful with companies that price gouge. Like for example, Intuit has been increasing prices massively over the years, and that's why they're losing their price-sensitive customers. You can say the same for FICO as well, although their customers are probably a lot more resilient than Intuit. So just 2 pointers to note here. Next one is SpaceX IPO. So SpaceX is going to IPO soon at a $1.2 trillion valuation. So this was their S1. They reported a TAM of 28.5 trillion. Yeah, trillion for the company itself, with 22.7 coming in from enterprise applications. So SpaceX primarily has 3 different businesses. We actually covered this in our Substack, so feel free to check it out. It's the link in the description below. They have Starlink, XAI, as well as their launch services. So in the case of SpaceX, the crown jewel of this business is their Starlink business. The Starlink business is one that has obliterated competition because it offers lower latency and lower cost as well. And then second of all is your launch business. Your launch business has high barriers because it is used by your national security, your US national security and NASA projects. It has completed more than 160 orbital launches in 2025. So the competitive moat here is indestructible. It is not replicable, and overall, the Starlink and the launch business are great. As for XAI, it's a company that is incorporating Twitter, which is X, as well as their Grok business and all the data center stuff. So this business segment was incorporated into SpaceX to sort of juice up the valuation because of your entire AI narrative currently. So in my opinion, however, the valuation is frothy. So it's similar across all the IPOs. So for example, I've seen some brokers trying to push for OpenAI's IPO with projections of 50 to 250% revenue growth over the next 5 years. So they're projecting 250% growth in 2026, all the way until 50% growth in 2030. So the current valuation for your OpenAI IPO at $850 billion is at 34 times price to sales. Anthropic is trading at 13 times based on the last round, which is 380 billion. But I expect it to be closer to OpenAI as well, around 30 times price to sales at a $900 billion IPO valuation. So in the case of OpenAI, I think the valuations are crazy. Why? Because number one, the business model is flawed because it is primarily consumer driven right now. So they have 82% coming from consumers. If you look at the Max 7 companies, most of them, they make money primarily through enterprises because enterprises are more sticky. Enterprises pay the big bucks. And that's what Anthropic has done. In the case of OpenAI, it's a model that is flawed. So the business is actively trying to pursue an enterprise route, which I think is the better play. But the valuation here doesn't justify it by any means. And paying 34 times price to sales at this IPO valuation is probably not right. But hot money is going to come in. I think the stock's going to move up after the IPO. We'll see. And I'll be sitting on the sidelines looking at the valuations go up with my Microsoft holdings, my Google holdings, as well as my Amazon holdings. Okay, next segment, let's talk about some interesting ideas that I found during the week. First of all is Booking Holdings. So Booking Holdings is an interesting company because number one, it has sold off a fair bit, and then you have fears with regards to this intermediation. So I'll try and tackle it here. There are a couple of fears that the markets are pricing in today. So Booking has fundamentally done well, and in the latest earnings report, pro forma revenue was up around 10%, EPS was around 15% adjusted EPS. And the company has sold off ever since because of your Iran war. So because of the Iran war, they actually reduced guidance by 2%. And that was the reason why the stock sold off a second time. So there are a few fears surrounding Booking today, primarily two different risks or fears. First of all is that AI agents will disintermediate your OTAs like Booking, reducing the need for their services. And second of all is the Google risk. It's still a significant challenger. So on disintermediation, there are a few different barriers that I would like to talk about. First of all, the company has a merchant model. Merchant model means you pay Booking, and then Booking holds the fees. And then once you're done with your entire travel, then Booking will pass it on to the hotels, taking that commission away. So Booking acts as sort of like a merchant of record. A merchant of record means that the company handles the operational side of the payment, the refunds, the chargebacks, any issues that you might have, all the different customer services when you're paying and you're traveling. But Google, on the other hand, has refused to be a merchant of record. They have actually said this publicly that they don't want to be the merchant of record because it is a very messy portion of Booking's business that Google wants no problems with. So there's one barrier that is preventing your LLMs from taking over your OTAs directly. First of all is that your LLMs, they don't want to handle this as well. So similar to Google, they don't want to be the merchant of record. They want to pass it on to Booking and claim a retainer fee from Booking, which is your referral fee. Adding on, inference costs are very high currently. So imagine you're going on to your LLM and then you're planning your entire trip on there. The inference cost tied to your conversation with the AI will outweigh the actual benefit that they receive from Booking itself. So that's why they want you to go straight to Booking. And so Booking has the entire infrastructure ready who consumers trust with licenses as well. So there are many different licenses that needs to be passed in order to be a global merchant of record. So there's a few more nuances. There are your cloud managing platforms that the hotels connect their database to. So think of it this way, they post their room availability on these cloud managing platforms. And then the cloud managing platforms will connect through Booking's APIs. So then there's another argument, which is that your cloud managing platforms can directly connect with the AI agents and then disintermediate or bypass Booking. So there's a counter argument to this as well. There is no one to sort the data if this is done, to determine which is better, to have reviews and so on. So imagine you going to your LLM, typing in what is the best hotel. Then the LLMs will either go on Google, which has unverified reviews, or they'll just give you a list of whatever is provided by your cloud managing platform. So it's not exactly useful as well. So, well, it's not impossible, but it's unlikely. On the supply side, if hotels, they choose to directly only list on your LLMs to bypass Booking's commissions, then they risk losing visibility and demand that Booking offers. So Booking is sort of like a visa in a way. So they balance the demand as well as the supply. They're sort of like in the middle. So you have a company here that's currently trading at 17 times, growing at 15%, with a CEO that was previously at a trading desk and understands the entire sentiment environment. Well, I think it's not a bad stock, and I'll be covering this in a full write-up soon. Next company that I'll be covering is a Chinese company. So Chinese stocks are probably cheap for a reason. So as we all know, on Friday, there was your Chinese regulators coming in to regulate two companies, Futu, which is Mumu, as well as Up Fintech, which is your Tiger Brokers. But I actually spoke to a fund manager and he offered a different perspective for your Chinese stocks. He is bullish on China. So he said that China is getting stronger by the day. The dollar is weakening while the yuan is strengthening. China is using Hong Kong as a hub for global transactions and economic activity. Not owning Chinese stocks could be a missed opportunity over the next decade. So that's his perspective. But back to Alibaba. So this is a company that I've been looking at over the past few days. It reported earnings a few weeks back. So the earnings were terrible for their core business. Their core business experienced a 40% decline in terms of EBITDA. And the cloud business is actually the only one that was sort of like a standout. So core business will normalize over the next few years with the government coming in to regulate the competition and the race to the bottom to fight for market share. I think Chinese companies, this is the problem with owning them. They love fighting for market share. Instead of raising prices, they're the one decreasing the prices. We've seen this in online retail. We've seen this in your EVs as well. Last time in your cloud businesses. But hopefully for Alibaba, the retail business can normalize. So I think for Alibaba now, the way to sort of like look at it or value it is through a SOTP, some of the parts. So 2 times price to sales for their core business and 25 times EBITDA for their cloud business is what is being priced in today at $130 per share. So for Alibaba, the story is quite compelling for their cloud business. So it's up 38% year on year with 9% EBITDA margins. And there's a few interesting things to cover for this segment. So first of all, they are operating on a different model to the one in the US. So in the US, besides the AI applications, the other reason why there is so much demand for your cloud is because they're moving from on-premise to on a public cloud service like your AWS, your Azure, your Google Cloud. But in China, a lot of your companies are actually state-owned enterprises. And what that means is that they don't want a public cloud. Instead, what they want is either a private cloud, which is low margin for Baba, or they want on-premise servers, which means there's no need for any cloud. So your Chinese companies are operating on a different model known as MaaS, which is Model as a Service. Model as a Service is higher margins as compared to your traditional cloud service because it is basically just licensing the brain of the LLMs through APIs. So with Qwen being the best model in China currently, this could work for Baba, with the company already implementing price increases. So the narrative now in the cloud business is a bit different because compute costs have gone up. What that has meant is that your price hikes are coming in. So previously, when there was a fight for market share, when everyone was decreasing prices, we saw that effect on Baba. Currently, we're seeing the opposite, which is increasing prices and your competitors following suit. So all in all, there's a strong narrative around their cloud business, which is number one, room for margin expansion. Second of all, a move from training to inference that will use more tokens and be more creative. Third of all is the company providing their own proprietary hardware through their chips. And then next one is the company having the ability to incorporate the models into their existing business. So if you think of the entire world, there's only two companies that has an entire ecosystem, including the cloud. Number one is Google. Second of all, it's Alibaba. There's no other company that has the ability to incorporate their AI as well as their cloud services into their existing business with an ecosystem like Alibaba as well as Google. But for now, I'll be watching the company. I'll do a full write-up if the valuation is compelling, if there is a significant discount to the SOTP currently calculated today. There are weaknesses in their core business, which is a worry, despite their strong cloud business. Okay, last two companies are more often around plays. It's two boring cable companies that are extremely cheap in terms of valuation today. One of it was actually pitched by David Einhorn. He pitched Versant Media, so I'll be covering this too. So this is more of a turnaround as well as a yield play. Both companies are currently trading at around 4 times earnings, 5 times EV to EBITDA. So that's around a 20% free cash flow yield for the company pre-capex. So we all know cable is a declining business, but when is the company too cheap to ignore? So in the case of Charter Communications, they have a massive refi war coming in from 2028 to around 2030. So refinancing this debt will lead to around a 3 billion increase in terms of their interest payments. But on the flip side, the management has actually said that they'll be trying to reduce their capex by around $4 billion. So balancing those two out, you get around a 20% free cash flow yield if their net income stays the same over the next few years, which is essentially the company buying back the entire business in 5 years' time. So even if you were to assume the business starts to decelerate in due time, the shareholder yield is still very high. So the risk here is probably just the company going bust if your rates are too high, if they can't service their debt. But other than that, it's an interesting company. There's another similar company in the case of Versant Media. This was a company that spun off from Comcast, which David Einhorn covered. If you guys are interested, I'll leave the link in the description below. I hope you guys have found this video useful and I will see you soon.